All right, let's start here. You've done the hard part. You built the income, you built the business, you climbed the ladder in medicine, law, tech, real estate, or corporate leadership. You're the expert in your world. But when it comes to your money, a shocking number of high-income earners and high-net-worth retirees are making mistakes that can cost them hundreds of thousands of dollars over their lifetime, sometimes even 7 figures. And here's the part that bothers me. These are fixable. They're planning issues. As we sit here in December 2025, think about where we are. The S&P 500 is up strongly again this year. After big gains in 2023 and 2024, we've had almost a 3-year run of double-digit stock returns. The Federal Reserve has now cut rates down into 3.5% to 3.75% range after a 3 straight cut in 2025. We're officially in a falling rate environment again, and Washington passed the One Big Beautiful Bill Act, which basically locks in the Tax Cuts and Jobs Act and adds new breaks, bigger standard deductions, a much higher SALT cap for many households, special perks for seniors, no tax on tips, no tax on overtime, 100% bonus depreciation, like the whole thing. So, we're heading into 2026 in a really unique spot. Portfolios are elevated, rates are lower, and could drift probably a little bit lower still, but tax law is more favorable to high earners and wealthy retirees than it has been in years. Which brings me to the big idea of this video. Begin 2026 with the end in mind. Like, not just what you want, but what you want to avoid. Most affluent families don't just dream in numbers, they dream in outcomes. I don't want to write a 6-figure check to the IRS every April. I don't want my kids fighting over my estate. I don't want to outlive my portfolio. I don't want to still be working 60 hours a week when I don't have to. So today, I'm walking through the top 5 mistakes wealthy individuals must avoid in 2026, especially if you're a high-income earner, business owner, physician, executive, or a high-net-worth retiree. So let's start with the one that quietly drives all the others. Mistake number 1, not beginning with the end in mind. Most affluent investors know how much they earn. Shockingly, few know what they're actually building toward. When I ask high-income couples, maybe they're physicians earning $700,000 combined or business owners with a few million in liquid assets, how much are you trying to accumulate? What does success look like for you and your family? I usually hear, I just want to be comfortable. I just want to have more than we have now. I don't want to worry about retiring. Although the feeling is real and important, the meaning within how you feel should be quantified. Beginning with the end in mind for a high net worth investor means 2 things. Positive clarity. What age do you want to work to be optional? What lifestyle? Where are you living? How much do you want to give? What legacy do you want to leave your kids, grandkids, and causes? Negative clarity. What do you absolutely want to avoid? Massive tax bills? Being illiquid but asset rich? Kids inheriting a financial mess? Being forced into required minimum distributions at literally the worst tax bracket of your life? Preparing for 2026 is the right time to be honest and transparent with yourself. When you begin with the end, the good and the bad, your planning becomes intentional instead of emotional. And that leads us directly to mistake number 2. Mistake number 2, not aligning 2026 with the future you just defined. Once you know the end, the next mistake is this. You make decisions for 2026 that don't support the future you want. Let me give you an example of how this plays out. You say you want to feel financially secure, but you're still invested like a 30-year-old. You say you never want to run out of money, but your withdrawal strategy doesn't match your portfolio structure. You say you want smooth, predictable income, but your tax planning is lumpy and reactionary. You say you want comfort, but you haven't defined how much cash flow comfort requires. Beginning with the end in mind is a philosophical approach. Aligning 2026 with that end is practical. This includes matching your risk exposure with your withdrawal needs, adjusting investment allocation for a falling rate environment. Okay, mistake number 3, not using the IRS playbook to support your end goal. Most wealthy individuals do this backwards. They treat the IRS like a bill collector instead of treating the tax code like a toolbox. If mistake number 1 is not knowing your end, and mistake number 2 is not aligning this year with that end, Then mistake number 3 is not using every IRS strategy available to get you to that end faster. This includes 2 major categories that high net worth families often neglect. Category A, tax buckets. Wealthy families get stuck in one bucket: tax-deferred, traditional 401ks, traditional IRAs, old employer plans. These accounts are powerful, but becoming wealthy in only one tax lane is dangerous. You want 3 coordinated buckets. Tax-deferred, most people only have this one, but you also need tax-free, Roth IRAs, Roth 401ks, strategic Roth conversions. And then you need taxable brokerage accounts, trusts, capital gain strategies. And you may ask why? Well, because your future self deserves flexibility. Years where you choose not to recognize income, years where you lower Medicare IRMA exposure, years where you fill specific brackets with pre-tax money, years where capital gains are more advantageous than ordinary income, years where Roth distributions protect your bracket entirely. When all income is forced through a tax-deferred straw, your future becomes extremely expensive. Okay, category B, high-value employer and qualified plan opportunities. Most high-income families ignore mega backdoor Roth contributions, deferred comp opportunities, HSA, long-term strategy, Roth 401k catch-ups, employer match optimization, after-tax contributions, equity comp tax planning. These are not nice perks. They are wealth accelerators. In 2026, taxes are more predictable than they've been in decades due to the extended Tax Cut and Jobs Act and the new big beautiful bill provisions. That means you know the brackets, you know the deductions, you know where conversion windows are, you know how much runway you have. If you don't use the IRS's rule book to support your long-term end goals, you are voluntarily giving away money that could have stayed in your family. Okay, mistake number 4. Expecting 2026 to behave predictably, you forgot that an unlived year brings uncertainty. Markets will surprise you. The economy will surprise you. Politics will surprise you. Interest rates may surprise you. Life itself will surprise you. Okay, so this mistake wealthy individuals make is focusing only on the plan and ignoring the opportunities that emerge when things don't go according to plan. Winning in unpredictable years means harvesting losses during volatility, harvesting gains when brackets or losses make it favorable, refinancing strategically in a falling rate environment, purchasing depressed real estate when the market softens, leveraging assets when liquidity creates opportunity, rebalancing portfolios when markets move sharply, reassessing safe withdrawal rates during abnormal periods, and shifting Roth conversion timing based on market dips, accelerating or delaying income based off of legislative uncertainty. Okay, that was a lot. The wealthy who win are not just planners, they are opportunists in disguise. Your plan must flex when the year becomes unpredictable, because unpredictability is the norm, not the exception. Mistake number 5, not having a systematic strategy you follow every pay period. Finally, the most foundational mistake. You don't have a systematic, repeatable process that guarantees progress. Well, that's going to be a problem. Wealthy families often operate like this. Big planning conversations once a year, random adjustments during market swings, occasional tax talk in spring, emotional decisions during downturns. We'll get to it eventually. Like, that's the statement you often hear in estate planning. That's not a strategy. That's a hope. A high net worth household needs a pay period funding strategy, automatic, predictable, aligned with the end goal. A quarterly review rhythm, not emotional, not reactionary. You need a visible structure. Are we on track? Do we need adjustments? What opportunities did the market create this quarter? Are we filling the right tax buckets? You need a successful team. You need accountability. A financial team comprised of a planner, a tax strategist, a CPA who plans, not just prepares, and a state attorney. Coordinated advice. Wealth is too complex to manage alone. Every high net worth family needs their version of no decision gets made without a second set of eyes. When you lack a system, opportunities get missed. When you have a system, wealth becomes predictable, repeatable, and transferable. So let's recap the top 5 mistakes wealthy investors must avoid in 2026. Not beginning with the end in mind and ignoring the outcomes you want to avoid. Not aligning this year's decisions with your long-term vision, letting 2026 drift instead of direct. Not using the IRS rulebook to accelerate your wealth, tax buckets, employer benefits, Roth strategy. Expecting 2026 to behave predictably instead of positioning yourself to win when it doesn't. Not having a consistent system and team. No rhythm, no accountability, no process. If you fix these 5 mistakes, 2026 becomes the year you finally stop reacting to your money and start commanding it. You've done the hardest work already. You built the income. You built the savings. You've been disciplined. Now it's time to optimize it. So lean in and catch this. You are likely paid a living because you yourself are a master as optimizing something for the benefit of others. Take the next few weeks and do it for yourself. And remember, AMG is here to help. I'm Andrew Nida, and if content like this is helpful for you, take a moment to subscribe to our channel. Also, don't keep us a secret. Share it now to the friend, coworker, or family member that comes to mind. See you next time.